So this session we'll be discussing about investors of investors. My name is Tsubasa and I'm the Singapore correspondent for Nikkei, and I'm honored to join this summit today for a sister publication and media company. So the title is Backing Emerging Market and First-Time Managers in Adverse Times. It gives kind of a gloomy outlook and tone, but at the same time, we have been seeing a number of first-time fund managers closing substantial amount for the investment funds. And today we'll be discussing some of the most recent trends and challenges and what it takes for first-time managers in this changing environment. So today we're very honored to have the perfect panelists to discuss this matter. And without further ado, I'd like to start the session first with a question for Yaping. So far this year, LPs seems to already be showing preference toward allocating funds to trusted relationships and making it a bit harder for first-time managers or those with limited track record. What is your view, and to what extent has the recent change in tide has actually shifted some of your investment strategies?
Yeah, actually LPs always have a preference to backing, funds with trusted relationships and long track record. So I think that hasn't changed. I think when people look at kind of first-time fund, it felt like, I don't know this person at all. And then I kind of back this person to launch his fund. But actually, in reality, you would have very many years of communication with somebody, whether in their previous career and been tracking their career, the investments that they have been making kind of before committing to them. But having said that, this year is harder. There's a global headwinds. I think the difficult part is really capital is in general more constrained, right? So when people have to allocate, I think there is a tendency to just go re-ups. And generally the bar is higher. So to your point, I think this year is harder, but it's not because they are first-time funds. And people don't trust them or don't know about their track record. Yeah.
How has it affected your assessment of some investments? Some points that you look more carefully into, or?
Yeah, so I think that part hasn't changed. I'm just trying to think, did we back somebody new this year? We have definitely backed emerging managers in the past, right? Actually, kind of looking at what Adam Street has done in Asia, kind of backing spin-offs is part of our strategy as well. Really identifying groups that maybe some other groups are less familiar with, but because we know them for a long time. I would say in terms of that process, it hasn't. But what really, because I cover Asia for Adam Street, right? And really the question is, should I allocate to Asia today, or which part of Asia? And between that, I'm probably not going to do X number of managers in Asia this year, probably 0.8. And I think that is part of your question list as well, right? Yeah.
Great. I'd like to look at some of the recent examples in the market. So Growthium Capital Partners had a first close of 400 million this year, and they have a target to double that to as much as 800 million. Asia Partners closed its debut fund at nearly 400 million, and Tower Capital Asia has also recently closed its maiden fund at the same amount. So in terms of regional VC funds, Deal Street Asia's report shows that the median value of the nine of the first-time funds closed in the first half of this year indicates rising fund sizes. My question is to Huaifeng. You've actually probably invested into one of the Growthium funds. Has the average size for both PE and VC funds increasing? And if so, what is the reason for it? And in addition, are we seeing a bifurcation between some of the first-time funds?
Sure. For those who don't know, IFC is the private investment arm of the World Bank Group, and we invest in emerging managers globally. In Asia alone, we have more than, I would say, almost 100 funds that we're invested with. So we do have long-standing relationships with all these managers. You rightly pointed out that we have done some, first-time emerging market managers. That is core to our DNA. And even in times like this, it's not something that we change. It's not a strategy that we change. I do see that, like what Yaping mentioned, there is also a flight to quality, right? So those managers that you know very well, in their previous lives, that they have done something similar before, you tend to back them again, even if it's a spin out or they're coming out under a different name. If you know them, you tend to back them, and hence some fund sizes are getting bigger just because the LPs know them better. But there is also a bifurcation between the smaller first-time funds and the bigger ones, right? Fundraising is very difficult. I think it's even more difficult for this part of the world, and very difficult if you're a first-time manager. So you do see some just struggling and hovering around that smaller check sizes, smaller ticket fund size, and they just never get there. So I do see a bifurcation. It just really, the story you tell and how long the LP has known you for.
Yeah, I'm interested in what are some of the attributes of a successful first-time fundraiser. Sarah, would you like to share your thoughts on that as well?
Yeah, sure. Hi, everyone. Really good to be back here in Singapore. It's been a while and really good to just get back together. And just a little bit of context. I launched the $1 Billion Fund for Women together with my co-founder, Shelley Porges, in 2018. And over the last couple of years, we've really had tremendous success and hit the $1 billion goal in terms of a pledge campaign to allocate more into female-founded companies. And that really created the shift into beyond the billion. And the reason why I'm sitting here today is because as we sort of went along the journey, we realized that it was not only the female founder to the VC, but also the VCs themselves who would most likely invest into female founders and allocate more. Are a lot of them challenged, as Hui Feng has said, with fundraising. Fundraising is a lot more difficult than anyone expects, even if they come from top quartile funds. Many of them were probably operational partners where they were responsible for the deal flow, things like that, but we're not necessarily looking out from a fundraising perspective. So what we realized was we needed to engage the limited partners around this discussion on how can we do better to drive returns through diversity, aligning profit and purpose. And with that, I think what we've seen is a couple of things, right? So we have 106 venture capital funds that we work with now, and also increasingly more and more limited partners from the profiles of foundations and endowments, family offices, high net worth individuals, and I am based in Washington, D.C. This is a global initiative, so happy to bring sort of that global perspective and, of course, the American view as well, which is where predominantly our operations are. From sort of what makes them successful, I think what we've seen is a lot of our managers fall into the emerging manager category, right? So that's Fund 1, Fund 2, Fund 3, no matter what the size. And especially in the early years, it's sort of a chicken and egg scenario, right? It's almost like I liken it to giving a young person an internship and you're looking for the job experience as they're applying for the internship. And it's a similar request of fund managers where they're being asked for their track records that not everyone in that position would have had the privilege and opportunity to gain that track record. And that's what makes it difficult. How they've overcome it is a couple of ways. One, I think it's about having a fundraising strategy. Many of them, before they actually spin out from their sort of initial funds, have identified anchor partners that will be able to underwrite the champion check, and that really helps to drive things, because at the end of the day, as much as we like to believe otherwise, LPs are still human beings that follow familiarity, right? So people that they know, trusted relationships, all these terminology falls into the habit of what are the patterns of success that I've seen before? And what that means is that people who may not have had those opportunities, that come from different backgrounds, don't fit into that mold of patterns of success, right? And it's incumbent upon LPs, all of us here today as capital allocators, to say, what can we do to change their narrative and make things different? So it's about having a strategy from day one, having an anchor that will champion your fundraising strategy through and through. And on top of that, what we've seen, the pledge campaign was the first pledge campaign of the $1 Billion Fund for Women was between 2018 to 2020, and it was $1 billion to be deployed by the end of 2020, and 638 million of that was deployed into close to 800 companies, of which 11 are unicorns. And what we found was that a lot of them were able to generate traction early by executing on SPVs, warehousing deals, and rolling that up into their key funds. So while it's been difficult, I've had funds where they spun out from places like Insight, right? They've had a track record, so on and so forth. But even with that, it took them 18 months to close the first check, right? So what did they do in the meantime? They built traction. They proved themselves over and over again that, hey, guess what? I don't have the capital right now, but if you give me a little bit, let me execute on this deal. Let me prove to you, because at the end of the day, what's the job of a VC? It's two things, right? One is you can prove that you can win the best deals. You can get into those deals and deliver on that. Number two is that you can fundraise and manage a firm. And ultimately, by showing initial traction, they were able to then go on to raise, that 18-month scenario. She closed a $50 million check at the 18-month, and after that, more and more checks were closed, and happy to report she's on to Fund 2 now and raising $200 million. She's done $150 million to date. So I've been very encouraged with a lot of this, and I think the key characteristic that I see that really differentiates an extraordinary fund manager is truly grit and resilience, right? And being able to say, how can I win today?
Great, thank you.
you.
Dave, your VC Capital just backed Ascend Ventures Vietnam, and it's a brand new fund, but the team is also from 500 startups. So a lot of these first-time fundraisers, they're not first-time investors or entrepreneurs, and they come fresh from what they've been doing already. So what do they bring to the table, in your view?
Well, what did they bring to the table?
Yeah.
So first, let me just throw out a few data points that LPs think about. First is the data shows that first and second time fund managers have better fund returns than later fund managers. That's just fact. I mean, it's not obviously everyone has better, but on average they do. So by missing out on first and second time fund managers, or first and second funds of fund managers, you're going to miss out on returns. We have backed a whole range of first-time managers, and we tend to focus on first and second, the odd third-time manager, usually when there's a sort of a micro fund starting, so the third is really a second. But we think that there's actually, the reality is you make a lot of mistakes in a first fund. And that's one of the challenges. And despite that, actually, a lot of first-time fund managers do well, because generally what's happening is good and attractive first-time fund managers come with a different value proposition than existing managers. And one of the things that we're seeing is not only they've learned from things that they've done in other careers or other places they've been, they've seen a new opportunity, and new opportunities emerging. I mean, the companies that are being invested in 2022 and 2023 and 2024 are very different than some of the companies that were invested in 3, 4, 5 years ago, because the market is constantly evolving. And just because you were good a couple of years ago at investing in e-commerce doesn't mean you're necessarily going to be good at investing in a climate tech in the next few years, or whatever the next kind of area is. So we backed the Ascend Vietnam Ventures team after looking at the market. There's Vietnam is the next up and coming market in our view for tech in the region after Indonesia, as far as where the market is and where really great entrepreneurs are, and really the ecosystem is building. And we really found that the combination of the experience they had from 500 startups, the connections into Silicon Valley in the US, plus a deep understanding of the team of the Vietnamese market and the growing thing was a really good fit. I'll make one other comment. There's two kinds of LPs. There's LPs that invest for fund returns, and there's LPs who invest primarily for actually getting deal flow for co-investments. And so you do have to distinguish between, we actually fall more in the second bucket. And so fund returns actually matter to us, but actually what's more important to us is access to great deals that we can actually co-invest in and put more money down and double down on and triple down on things. So I just, as you're thinking out there as a fund manager raising capital, distinguishing those two buckets is actually pretty important.
Yeah, I think so. Dave just mentioned about some of the strategies, and it actually diversifies some of your investments. So to LPs investing in these funds, it diversifies their strategy, and which can add up to their return profile as well. But larger institutional LPs, they tend to have easier time to commit to first-time fund managers due to the internal resources and larger portfolio. How does it work for different types of LPs?
Yeah. Actually, we see there's a lot of under-resourced large LPs. This is where I guess fund of funds like us come in. So there's different categories. So there are very large LPs, U.S. pension funds, but actually very under-resourced, don't have boots on the ground. There are also kind of sovereign wealth funds who are large and are generally better resourced. But actually for both category, I do see, because they are large LPs, so for them to spend their time, they need to write larger checks as well, right? And for a lot of the emerging managers, they are not raising billions of dollars. Some very rare category do. So maybe they raise 100, 200, and these LPs are writing like 500 million equity check, right? And in many cases, they actually do not. Some of them might have a small category for emerging managers, but I would say the focus of their time is really writing these larger checks. And also co-investments are an important part for the more well-resourced LPs.
Yeah.
The other thing is for the larger LPs, they meet with the most senior team members of the funds. And then if you're thinking about kind of backing first-time managers, usually they are not the first-generation leaders, right? They're very good investors, and they actually don't see a lot of LPs. They were like really focused on investing. And this is when you kind of need boots on the ground, people kind of meeting, not just with the general partner, but the third guy doing investments. And your team also needs to have layers, right? So you kind of spend time with these people, knowing what they're working on. So I think one of the questions you may or may not have asked is like, what makes, and actually you asked Sarah, right, what makes a first-time fund manager successful? I would say quite generally, they are very good investors. They are focused on investments, but they are not spending time with LPs. They are not marketing themselves. So one thing that, let's say if I am a second generation investor in a direct fund, for example, I would, because actually quite often they find, I just want to focus on investments. It's a waste of time. Like somebody else is doing the fundraising. But you need to build that kind of connection, right, before you decide to launch your own fund. And as Sarah said, like when you do that, you must have an LP that knows you well enough to really anchor the fund. So you're not just coming in blind, kind of like meeting everybody and seeing who might invest in you. Yeah.
Right. Thank you. Hui Fong, so speaking regionally, how does Southeast Asia benefit as new investors might seek a path to enter from China or maybe even Europe? Since they're new, will partnering with emerging funds pay off? Will be better? Or do we see a flight back to quality on the familiar ground?
So we see two models, right? So we have seen and backed also fund managers where, they partner, they're not from here, they partner with someone on the ground, and they manage to, have a successful partnership and launch a family of funds. We have done things like that. But those are, I would say, relatively rare, because of course, just to select the partner on the ground takes a while, right? And if that partner already is good at investing, has shown DPI, has been in the market for a long time, they can launch a fund themselves, right? So that selection process is not easy. Of course, there have been successes in the market, and we have backed them, but I think that path is not easy. From the LP's lens, we think that the more partnership involved, the more kinks you have to solve, right? There's just might be more friction. There are more agreements you need to agree on. There are more modus operandi that you need to follow. So it is not necessarily the best model, unless of course you find a perfect fit. We have also seen the other side, whereby like. For instance, I think this 2 weeks we see a lot of Chinese GPs, a lot of European GPs coming and thinking about Southeast Asia, right? Diversifying their portfolio, their pipeline. I think that's also a good step, but my advice would be just don't come in blind, right? If you had never done anything here in the region, this is a very heterogeneous region. If you don't know the market well, then don't just jump into it blind. Maybe start off with 1 or 2 deals in your current fund and slowly prove and set up, that track record before you launch a dedicated Southeast Asia fund.
So it can be quite challenging for some of the new fundraisers, but with all these challenges, so I mentioned that the 9 first-time funds reaching final close this half year, and this is actually up the 7 debut funds that closed in the whole of last year. And in 2020, this was number 5, so it's been increasing. Sarah, I'd like to ask you, how will the competitive landscape get more intense, and how can GPs differentiate themselves in this current environment?
Yeah, thanks for asking that. So, despite, I guess, what we are feeling and seeing, the doom and gloom, right? It's been a record year with regard to the amount of fundraising, and what we're seeing is a lot of funds that have been successful, that have raised those $1 billion and more, are sort of being slow to deploy, right? So I think there's a bit of a market correction that's happening. I think we're going to see markdowns with previous vintages that's going to happen, and it'll be a while before it trickles down. But no matter what, innovation will continue. I think some of the, remember, we're all here because we believe in venture, right? And the fact that a lot of the top companies from Airbnb, Uber, WhatsApp were born in a time of market downturns. So I think this will continue to be an opportunity. It will be competitive, but what we'll see is we'll kind of see a little bit of a returns dispersion. As Dave had said, the outperformers of first-time fund managers, the emerging manager story is a very strong one, right? But the reality is emerging managers are the top performers. They will continue to outperform, and yet they remain undercapitalized, right? So looking at the U.S., you asked me previously as well, in terms of what we're seeing in the U.S. Between 2008 and 2018, right, the growth of VC, the allocations into VC has grown tremendously. But the percentage of what has gone into emerging managers has decreased significantly, right? So comparing 2018, it was 66% that went into established managers, and compare that to 2008, which was 34%, right? Which means that, there's a flight to the more established, which means it's going to be increasingly more challenging for emerging managers. But having said that, the data is there, and I think it's incumbent upon managers to really differentiate themselves by a few things, right? To be really clear on what is your niche. Where are you going to win? I like to win, clearly, so I use that a lot of times, but how do you position yourself to be truly unique? And what we've seen is a lot of specialists. So the profiles that I see a lot with emerging managers that I actually like are those that were previous operators that have a specific niche, which means that they will have that arbitrage opportunity of a few things, right? Of verticals. So we've seen funds that are very specialist into, say, deep tech, into biosciences, life sciences, biotech, things like that, that have really tremendous, TVPI, IR, MOIC, all of the metrics that we care about. And as well, geographic arbitrage, actually. So we've looked at funds, for example, that, have a specific view into, say, Africa, or even in emerging Asia, right, with a specific niche. So I think really being very clear about who you are and who you are not from day one is going to be very important, and sell that story again and again with LPs. Ultimately it is a relationship business, and it's about proving that you are what you say you are, and you are going to do what you're going to do, right? What you promised to do. And of course, if I may, with LPs moving more and more increasingly to think more about ESG, sustainability, I think, the train is leaving the station. We all need to be thinking about diversity, equity, inclusion, sustainability, and building businesses that invest into themes we care about, that will shape the lens of our world. And I think it's an opportunity, and I welcome GPs that are, in fact, what we're doing with our LPs is our LPs that work with us are getting their GPs to pledge to the $1 billion fund for women and beyond the billion, to make a commitment, a dollar amount to be invested into female founders and diversity, right? So I think, going the extra mile, right? Developing a brand, not just only doing investments for investment's sake, but really thinking about why, right? I think especially the next generation, we're in Singapore, and I was just looking at the stats because I'm hosting an event with family offices tomorrow. And the growth of family offices, next generation wealth, there's going to be one of the biggest generational transfers to, millennials and baby boomer wives actually as well, because of the lifespan. These women, these next generation, are thinking about impact, right? So as much as returns are going to be important, how does your return strategy also bring forward the profit and purpose story? And I think that's how we make things different and win.
Yeah.
Thank you.
Speaking of stories, so Dave, your VC, you guys are focused on the global south. If you can share your thoughts as well, how can GPs differentiate themselves in this challenging time?
Yeah. So as you said, we invest across the global south. So we started in India 10 years ago, and then we've expanded over time into Latin America, Africa, and most recently into Southeast Asia. And I think one of the things that we're seeing as a trend is to specialization of GPs to differentiate, so having more deep knowledge of a few sectors, not necessarily one sector, because there's always this question of you want to have an openness to see opportunities you couldn't have thought about, ahead of time, because usually you're picking your companies over 2, 3, 4 years, and so you want to have some flexibility. But I think having differentiation, especially against managers who, larger managers who, are more generalists, I think being a specialist gives you an ability to get into a cap table, get into a great company, add value to a company in a unique way. And allows you to compete better. I think another thing that we're seeing is diversity of teams. We think that having teams that have diverse perspectives is going to enable you to find better opportunities, particularly for areas that are emerging and changing culturally in places. I don't know. I mean, you'd think that a lot of the companies built in the United States would just transplant, because they've built these great technologies and things. They just transplant into Southeast Asia, but a lot of times there's just significant local behavioral issues and specifics. Obviously, there's regulations and other things. So I think having more knowledge about that is a differentiator. The other thing that we really emphasize is diversity, culturally, and gender is important, and increasingly, I think, in funds to have an edge, honestly, to be able to outperform other ones.
Great, thank you. I think we have a few questions from the audience as well. The first question I'd like to read out. How are LPs working on blending private sector capital with DFI capital in emerging and frontier markets in order to create a sustainable investment? If any one of you would like to take a go.
Yeah, so I can take that. So at least in our investments, right? I mean, given that we invest a lot in emerging managers and first-time managers, a lot of times we are alone with other DFIs, right? A lot of other development banks, because, I mean, if we are not the ones putting the first check, then who else would, right? So I think we have tried to bring in and mobilize private capital. That's also a KPI of ours. So getting our GPs to go out there and also, reach out more actively to sources of wealth. And at the same time, we also have pools of capital that we partner with and mobilize alongside ourselves into, specific sectors or different focuses like climate tech, etc. We also bring those money in. But after, 1 or 2 funds, we would expect the fund managers to be successful enough to graduate, right, and to at least get some more private capital on their own. We don't expect them to remain DFI-only funds. And that's when the conversation really starts, right, when we really grill them about it. So there is a lot of interest in making sure we blend both private and DFI capital, and a lot of action that we take on that.
European, do you have any thoughts on the question?
Yeah, I think the thing that I'll add is clearly there's a lot more focus on ESG, and actually with Adam Street, we are very happy whenever IFC is one of the LPs, because they do have a very comprehensive checklist, and this is where, for a fund manager, both DFI and private sector capital can be working together.
Sure.
Yeah, may I jump on that
please,
with a different angle? What we've seen actually in America, which I've been very encouraged by, so one of our key sponsors is Bank of America, for example, where they have actually a specific venture capital allocation program from their balance sheet. And I'm hoping to see more and more financial institutions in Asia do this, and part of that is, for them, of course, it's a return strategy. They're building their ecosystem. They're working with clientele that want these sort of products as well. And, I think it's an interesting blend, because once we get these sort of checks, right? So Bank of America, they're writing checks that are a lot bigger. And, one of the things that we talked about with institutional LPs is the challenge is always, I can't be more than 30% of a fund. And the smallest check size, 500 million for some, 100 million for some, which means that the emerging managers don't stand a chance at all. But what they're doing, a lot of these financial institutions, foundations, endowments, they're pretty big in the US, right? And they are actively investing in VC. So they've increased their allocations, because I think it's clear that the alternative strategy is the way to go. I think that strong belief that, with the bond rates and, fixed income, things like that, alternatives is going to be something that will always be part of the portfolio and an important one, even with the denominator effects, so on and so forth. But increasingly, we're seeing all these institutions play an active role in thinking about emerging manager programs, to think about how do we support these managers even as they're just starting out, they're just getting going. We're seeing foundations that are even helping from an LP perspective, from the back office and things like that, which I think is an interesting blend of private and public sector as well, because of course, especially in emerging markets, you'll see the IFCs of the world, the DEGs, the institutional folks that care about the development of these regions. But importantly as well, I think we're starting to see the financial institutions and big financial players really play a role, and I think that's going to continue to be important.
Dave, how about you in terms of some of the the sustainable side? How do you look at it in this region?
Yeah. Interesting. I mean, we invest across a bunch of different regions, and so DFIs have different roles, I would say, in different regions. Much more present in frontier markets as far as percentage of capital and activity. I think a lot of the DFIs are late to the party here in Southeast Asia for VC, which is, I guess, okay. But I think a lot of the private capital has come in first. But I think in developing markets outside of the core markets, such in right now the core markets being Singapore, Indonesia, Vietnam, a little bit Philippines, but Philippines is really still developing. Obviously, there's some other smaller markets or other markets in the region as well. But I think it's a great opportunity to be collaborative. IFC is an investor in our fund, and we appreciate and have learned a lot from them on how to think best about ESG, and we've also helped them think more about ESG and applicability to venture, because it's a little different than applicability to private equity and other kinds of investments. So it's been a good two-way street.
Yeah. Do you have any more questions from the audience? No.
Actually, I'll add for kind of impact and sustainable investing. Sometimes the challenge is balancing the impact and sustainability part of it with financial returns, because ultimately people who invest with us, they do want a certain financial returns, right? And the other thing you do not want is kind of you invest in a fund that's dressed like an impact fund, but actually it's a lot of greenwashing. So I was actually curious, for IFC, do you do a trade-offs between the financial returns and kind of the doing good part?
So that's a taboo question. No, I mean, the official pitch is there's no trade-off, right? So I think by now the ecosystem has already matured enough to know that ESG is not a by-the-way thing that you can do, or impact is not like a by-the-way thing, I think a lot of people are now self-starters. Down from the founders, actually. The founders want to do good, they want to incorporate ESG, they want to incorporate impact. It goes up to the VCs or the PE funds, and the LPs also from top down want it. So I don't think that it's a question now. That is a good thing. For us, all along we had already requested for it, and it's a deal breaker for us if you don't incorporate these two elements right from the beginning. So we started investing over 50 years ago. We've always had these two lenses in mind. I don't think there is a trade-off. It depends on at what point in time you take measures, right? So. If there's a fund or a company that goes all out, ignores all ESG elements or impact elements and gets the best returns, at that point in time, it might be the best and the strongest winner, but it might not last 10 years. So it depends on what point in time you take measure as well.
Sweet. Just on the previous questions that I asked, just on the competitive landscape, I'd like to hear some of your thoughts as well, Yaping, how GPs can have an edge over some of the other new funds, and how they can differentiate themselves in this environment.
Yeah. I think some of the points I've already said, right? Kind of first building the relationship even before your fundraising, and the other is for the GPs to look around them, like if I'm just another kind of lower mid-market buyout fund targeting the same sector, what really are your strengths? What difference do you bring to the table? I think as the kind of private equity gets more mature in the region, there's just more players around, right? Before, I think getting access to deals, kind of riding out the market is the way to go. But increasingly, the portfolio companies have choices as well. Why should I? Because this is a competition for, it's a weird competition. You're trying to give out cash and people are being selective. So what do you bring to the table? I think some GPs kind of differentiate from the people they have, or maybe tagging to a very strong strategic, which they kind of bring that strategic and how that add values to their other portfolio companies. So I think Sarah mentioned it before too, right? As a GP, how do you? I think in the good old days, sometimes it's like, this is really hard to say why this GP is special. Maybe he's just a very good tennis player, no unforced errors, right? I think it's just getting harder. So you need to have an edge now. Like, are you a very good, server or good at defense, etc. One thing I would say is LPs are always looking for a perfect, well-rounded GP. It doesn't exist. It doesn't exist even in a pan-regional team. It doesn't exist in a human being, right? And therefore, how do you complement, your shortcoming, or how you make the best use of what you have?
I'd like to hear some of the U.S. views. How's just around you, back home? How are they seeing this market this year? Some people say, still strong growth. Obviously, long term, a lot of strong potential. But compared to the last few years, how has the interest been lately?
Yeah, so thanks for asking that. As I mentioned a little bit earlier, I think the market is nuanced, right? I think the news all around us with inflationary pressures, things like that, stock markets crashing and all that is weighing heavy on a lot of people, so where they can. And in fact, I think it's also helpful as we think about the LP view to also go further down sort of the supply chain or top of the supply chain, depending on how you think about it. But a lot of the portfolio companies, those that are thinking ahead, are already raising quietly and quickly with people that they know to ensure that they have enough runway, so doing bridge rounds, things like that, to be able to carry them through so they don't have to discount their valuations, which is where a lot of actually LPs, a lot of GPs are sort of scouring around for deals that they think, will have outsized returns, right? So from a vintage perspective, I'm confident and I'm optimistic that this year would be one of the best vintage years with the good deals that we will continue to find. But for some of the best deals, there will be a little bit of a waiting out that we're seeing. So next year, for example, I'm actually seeing that growth stage investing will make a bit of a comeback. So a lot of those growth stage return type portfolio companies are actually holding it out for now, right? But they can't hold out forever if they want to sort of build for growth. So we'll start to see that hopefully next year. But I think, from a fundraising perspective, again, it's sort of nuanced in the sense that there will be the winners. I think, as I said, there will be a returns dispersion. There will be winners that will emerge from this that will be able to pull through, but there will be those that will just be wiped out and say, I can't fundraise in this environment. I can't carry through. And I think for GPs in the room, this is a lifestyle choice, right? Remember, you only get your management fees when you have capital under management. So plan early. And the key thing, if there's a key takeaway, it's everybody that I've worked with from a fund manager perspective, whether they're, the top brands or not, it's fundraising it's a lot harder, and it will always be a lot harder than you think, and it will take a lot longer than you think. So be prepared for that, and especially during a market downturn, sure, there's a lot of opportunity, we'll see winners, but there will be some pain along the way, and I think we're really starting to see that. So yeah, hopefully that gives a little bit of flavor there.
Great, thank you so much. I think that brings us to the end of the session, and I also hope to closely follow some of your investments that you've made recently, and some of the activities shared by our panelists today. Thank you very much, and I hope you enjoy the rest of the summit. Thank you.